Here's a question that should genuinely terrify you. Who decides how much your money is worth? Not what you earn, not what you spend. What your money is actually, physically, mathematically worth when you hand it to the cashier at the grocery store. Because somebody does decide that. Every 6 weeks or so, 12 people walk into a room in Washington, D.C. They sit around a 27-foot-long mahogany table. They argue for about 2 days, and then they make a decision that determines whether you can afford a house, whether your car payment goes up, whether the company you work for can afford to keep you on payroll. And here's the part that should keep you up at night. You didn't vote for a single one of them. Not one. I spent an embarrassing amount of time not understanding this. Like I'm talking years of pretending I knew what the Federal Reserve was. Nodding along in conversations, saying things like, yeah, the Fed's really in a tough spot right now, with absolutely zero idea what I was talking about. And look, I don't think I was alone. So today we're going to do something that apparently terrifies the financial industry, which is explain how the entire Federal Reserve works in plain language. How 12 unelected people control your money. Why they do it. What tools they use. And then, right at the end, we're going to ask a question that I promise will flip everything you think you know about democracy completely upside down. But first, we need to talk about Rebecca. Rebecca is 34. She teaches 9th grade history in Columbus, Ohio. And last year, something happened to Rebecca that happens to millions of Americans every single year, and almost none of them understand why. Her school district gave her a raise. 3%. That's real. That happened. Her principal shook her hand. Her union rep sent her a congratulations email. 3%. And then her landlord raised her rent by 11%. Her grocery bill went up 14%. Her car insurance jumped 19%. So Rebecca got a raise, and she is now poorer than she was before the raise. That is not an accident. That is not bad luck. That is a policy outcome. Somebody made a series of decisions that led to Rebecca's paycheck buying less stuff than it used to, and the somebody in question is the Federal Open Market Committee, or FOMC, which I promise is the most powerful group of people you've never heard of. So let's start with the basics. What is the Federal Reserve? And I know that sounds like a kindergarten question, but I guarantee you 70% of American adults cannot answer it correctly. And honestly, I would have been one of them 5 years ago. The Federal Reserve is not a bank. Not in the way you think of a bank. You can't walk in and open a checking account. It's not federal in the way that the post office is federal either. It doesn't get its money from taxes. And it's not a reserve in the way you think of a reserve, like a pile of gold sitting in a vault somewhere. The name is essentially 3 lies stacked on top of each other. And I am not sure if that was intentional or just the most perfectly misleading branding in American history. What the Federal Reserve actually is the Central Bank of the United States. It was created in 1913 after a series of financial panics where banks literally just ran out of money and people lost everything. The idea was simple. Create a backstop. A lender of last resort. A place that could inject money into the system when the system was collapsing. That's it. That was the pitch. And 113 years later, it has become arguably the most powerful economic institution on Earth. Here's how the power structure works, and this is where it gets genuinely weird. The Fed has a board of governors, 7 people. They're appointed by the President of the United States, confirmed by the Senate, and they serve 14-year terms. 14 years. That is longer than any president serves, longer than most senators. These 7 people don't run for election. They don't campaign. They don't knock on your door asking for your vote. They get nominated, confirmed, and then they're just there for 14 years making decisions that affect every dollar in your pocket. Now, just 3 weeks ago, the 17th chair of the Federal Reserve, Kevin Warsh, was sworn in. He replaced Jerome Powell in the most contentious confirmation in Fed history, 54 to 45. A political knife fight over who gets to sit at the head of that 27-foot table. And here's what kills me. Most Americans couldn't name the old chair. Most Americans definitely can't name the new one. But both of those men have had more direct impact on your cost of living than any president you've ever voted for. But wait, we haven't gotten to the 12 yet. The Board of Governors is 7 people. The magic number is 12. So where do the other 5 come from? This is where the system gets truly bizarre. The United States is divided into 12 Federal Reserve districts. Each district has its own Federal Reserve Bank with its own president. The president of the New York Fed always gets a vote on the FOMC. Always. The other 11 rotate. 4 of them get to vote each year on a fixed schedule. So the 12 voting members of the FOMC are the 7 governors, the New York Fed president, and 4 rotating regional presidents. And I want you to sit with that for a second. The regional Fed presidents are not appointed by the president. They're not confirmed by the Senate. They're selected by the boards of directors of their regional banks, which are partially made up of commercial bankers. Bankers choosing the people who regulate banking. If I wrote that in a movie script, you'd tell me it was too on the nose. So that's your 12. 12 people around a table, meeting 8 times a year, deciding the single most important number in the American economy. And maybe in the world. Because here's the thing about the Federal Reserve that I don't think most people appreciate. When the Fed makes a decision, it doesn't just affect America. It affects every country that trades in dollars, which is basically every country. The Fed sneezes and Brazil gets a cold. The Fed raises rates and a factory in Bangladesh shuts down. This is not an exaggeration. This is the documented, peer-reviewed, objectively observed reality of how interconnected global finance works. And now you're probably thinking, okay, but what do they actually do? They set interest rates, right? And yes, that's the headline version. But the reality is so much stranger and more powerful than that. Let's talk about the tools. And this is where things get truly wild, so stay with me. The primary tool is the federal funds rate. This is the rate at which banks lend money to each other overnight. Right now, June 2026, that rate sits between 3.5 and 3.75%. That sounds boring. It sounds technical. It sounds like something that only affects bankers. But here's what that number actually means for Rebecca in Columbus, Ohio. When that number goes up, it becomes more expensive for banks to borrow money. When it's more expensive for banks to borrow money, it becomes more expensive for banks to lend money. When it becomes more expensive for banks to lend money, it becomes more expensive for you to get a mortgage, a car loan, a business loan, a credit card. Your rent goes up because your landlord's mortgage costs more. Your groceries go up because the company shipping them borrowed money to buy trucks. Everything you touch in your daily life has interest rates baked into the price, and you never see it. When that number goes down, the opposite happens. Borrowing gets cheaper, businesses expand, hiring picks up, asset prices rise. Your 401k looks great. But there's a catch, and the catch is inflation. Cheap money floods the system, more dollars chasing the same amount of stuff. Prices go up, your paycheck buys less. Rebecca's 3% raise evaporates. This is the impossible tightrope. Raise rates too high, you crush the economy. People lose jobs. Businesses close. Lower rates too much, you ignite inflation. People's savings melt. And the 12 people around that mahogany table have to walk that tightrope every single meeting, knowing that millions of real human lives hang on which direction they lean. But the interest rate isn't even the scary tool. The scary tool is something most people have never heard of, and I don't blame them because honestly, when I first learned about it, I thought somebody was pulling my leg. It's called quantitative easing, and what it means, in actual plain English, is that the Federal Reserve can create money out of thin air. Let me say that again, because I need you to really hear it. The Federal Reserve can create money, not print it, not transfer it from somewhere. Create it. A person at the Fed sits down at a computer, types a number, hits enter, And billions of dollars that did not exist 30 seconds ago now exist. They use that money to buy government bonds and mortgage-backed securities from banks, which puts cash into the banking system, which theoretically flows out into the economy as loans and investment. Between 2008 and 2014, the Fed created roughly $3.5 trillion this way. Trillion. With a T. During the pandemic, they did another $4.8 trillion. Combined, that's more money than the entire gross domestic product of Japan. And here's the thing I want you to understand. Every time they do that, every single time they create money out of nothing, the money already in your pocket becomes worth a little bit less. It has to. It's math. If there are more dollars chasing the same amount of goods and services, each dollar buys less. That's inflation. That's why Rebecca's 3% raise doesn't feel like a raise. Now I know what some of you are thinking. This sounds terrible. This sounds like an unaccountable shadow government manipulating the economy. And look, I get it. I had that reaction too. And I'm going to be honest with you, there are legitimate criticisms of how the Fed operates. The revolving door between the Fed and Wall Street is real. The fact that Fed officials were caught trading stocks during the pandemic while making policy decisions that affected those exact stocks is real and is genuinely indefensible. The lack of diversity on the FOMC for most of its history is real. These are not conspiracy theories. These are documented problems. But now we need to get to the part that changed my entire understanding of democracy. And I don't say that to be dramatic. I mean, it literally changed how I think about how governments should work. What if the 12 were elected? Seriously. What if we took the Federal Reserve and made it democratic? What if the chair of the Fed was elected by popular vote, like a president? What if the governors were elected, like senators? What if the people controlled their own monetary policy, the way the people control, at least in theory, everything else in a democracy? Sounds great, right? Sounds fair. Sounds American. It's been tried. And every single time, it has been a catastrophe. Let me tell you about Frank. Frank is 61. He drove trucks in Tulsa, Oklahoma, for 32 years before retiring. And Frank remembers something that most people under 50 have never experienced. Frank remembers 1981, when the federal funds rate hit 20.06%. 20%. Try to imagine that. Right now, you're complaining about 3.75. Frank was living through 20. His mortgage rate was over 18%. His neighbor lost his house. The auto factory 3 miles from his apartment laid off 400 people in a single afternoon. And the man who did that, the man who deliberately pushed interest rates to 20%, was Paul Volcker, the Fed chair at the time. And Volcker did it because inflation was running at 14% and the economy was spiraling. He knew it would cause a recession. He knew people would lose jobs and homes. He knew it would be the most unpopular thing he'd ever do. And he did it anyway, because it was the medicine the economy needed, even though the patient was going to scream. Now here's my question. If Paul Volcker had to run for election, would he have done that? If raising rates meant losing his job in the next election cycle, would any rational politician inflict that kind of short-term pain for long-term stability? The answer is no. And we know the answer is no because we can look at what happens when politicians do control monetary policy. Germany, 1923. The Weimar Republic. Politicians printed money to pay war debts. Inflation hit 79.6 billion% in a single month. People carried cash in wheelbarrows. The price of bread doubled every few hours. A loaf of bread cost 200 billion marks. 200 billion for bread. Zimbabwe, 2008. The government printed money to fund a war. Inflation hit 79.6 sextillion%. That's a number with 22 zeros after it. People's life savings became worthless overnight. They literally used banknotes as wallpaper because the paper was worth more than the currency printed on it. Venezuela, 2018. The government pressured the central bank to print money to fund social programs. Inflation hit 1.7 million%. A cup of coffee cost 1 million bolivars. Turkey, 2022. The president publicly pressured the central bank to lower interest rates despite soaring inflation. Inflation hit 85%. The lira collapsed. Ordinary Turkish families watched their savings evaporate in real time. Every single one of these disasters has the same origin story. A politician who needed to win the next election made a short-term monetary decision that caused long-term economic destruction. Every single time. And this is the click. This is the thing that rearranged my brain. The reason the Federal Reserve is not democratic is because democracy made it that way. The American democratic system looked at its own worst impulses, its own tendency to sacrifice tomorrow for today, its own inability to make unpopular decisions, and it deliberately created a body that was insulated from those impulses. It's not a bug, it's a feature. Democracy built a non-democratic institution inside itself, on purpose, to protect itself from its own worst instincts. That doesn't mean the system is perfect. It's not. It doesn't mean the 12 shouldn't face more accountability, more transparency, more diversity. They absolutely should. And it doesn't mean you shouldn't understand what they do, because you absolutely must. Because here's the truth that nobody in finance wants to say out loud. The system only works if you understand it well enough to push back when it doesn't. Frank in Tulsa didn't have the language to understand what was happening to him in 1981. Rebecca in Columbus doesn't have the language to understand why her raise made her poorer. And that ignorance is not neutral. It benefits the people who already understand the system. It benefits banks. It benefits Wall Street. It benefits the people sitting in those rotating FOMC seats who never had to shake your hand and ask for your vote. So what do you actually do with this? 3 things to hold on to. Number 1. Understand that the Fed's next meeting is in 2 days, June 16th and 17th, and it's the first meeting with Kevin Warsh as chair. Watch it. It's live. It's free. It's on the Fed's website. Every press conference, every statement, every dot plot, it's all public. The most powerful economic decisions in the world are made in public and almost nobody watches. Number 2, know that every financial decision you make, every mortgage, every savings account, every investment exists within the gravitational field of the federal funds rate. When you see that number move, you should feel something because it's directly connected to the price of your life. Number 3, vote for people who take Fed appointments seriously. The president nominates the governors, the Senate confirms them. Those are elected positions. Your vote determines who picks the 12. That's your leverage. That's your thread of democratic control in a deliberately non-democratic system. Don't waste it. I know this channel is supposed to make finance feel simple. And look, I tried. I really tried. But some things aren't simple. Some things are complicated because powerful people benefit from the complexity. And the Federal Reserve is one of those things. All I can do is hand you the map and hope you use it, because 12 people you never voted for are meeting in 2 days to decide what your money is worth. And now at least you know their names, or at least where to find them. This isn't financial advice. The characters in this video are composites built from public data and real patterns, not specific individuals. But the numbers are real. The power structure is real. And the decisions that affect your life are happening whether you pay attention or not. I'll see you in the next one.